In this video, I want to discuss a rather controversial way of making money in the stock market. I want to talk about short selling. Short selling actually is somewhat controversial, as I told us earlier. And in some countries, this particular practice is banned. In my country, Nigeria, we don't have short selling. We don't do short selling. And short selling actually has to do with making money the when stock prices drop. You make money as a result of the stock price going down. So what essentially is short selling. Well, short selling is a trading strategy where the investor borrows shares of a stock. The belief will decrease in value, not increasing, the belief will decrease in value, and then sell those shares at the current price, right? And later repurchase them, at a lower price to return those shares to the lender, profiting from the price difference. Are you following? The scout for stocks they feel is going to drop or is dropping in value. All right, they would borrow those shares. All right, and then they will sell those shares at the current price. Okay, so after selling them, they will later rebuy those shares at a lower price and return the shares to whosoever they borrowed the shares from. And by so doing, they profit from the price difference. That's essentially what short selling is all about. Now, how does it actually work? I want to re-emphasize how it works. Now, you borrow shares from a broker, typically for a fee. A broker would borrow you shares, or rather, a broker would lend you shares. You borrow the share from the broker at a fee, and then you sell the borrowed shares at the current price. All right, and then all things being equal, the stock will keep on going down. The stock price will keep declining. All right, so you later, repurchase those shares. The shares you earlier sold out at a particular price, you repurchase those shares at a lower price. All right, and then ideally at a lower price, and then you return the shares to your broker, and by so doing, you profit, in the process. For example, let's take a typical example or a hypothetical example. Let's say a stock of a company XYZ is trading at $100, and you expect that stock to drop to $80. All right, so you may borrow, let's say, 10 shares from your brokers. So 10 shares you borrow from your broker, worth $100 per share. That's $1,000, right? So you now sell the shares. You borrow and sell at $1,000. Okay, so when the price drops to $80, okay, you buy back those shares at $800. Okay, the shares we sold at $1,000. When the price drops from $100 to $80, you buy back those shares at $800. All right, so the difference here is what? Is $200. All right, so $200 minus cost and minus fees, you now pocket the difference as your profit. That's essentially how our short selling works. You profit when the stock price goes down. I want to highlight the benefits of short selling. So you profit when the market goes down, or when an undervalued stocks is undergoing correction. When the price is going down, you can profit from that particular action. Number two is a kind of hedge against your long positions. As a typical investor, you would have your long position, your long-term investments. You equally have your shorts as stocks you could share, you could short sell. So it's a kind of hedge. If your long positions don't do very well, at least your short position should be able to perform better. So you are kind of hedge. You have that particular, your risk is being mitigated. Number three is that you identify and correct overvalued stocks, contributing to market efficiency. Whenever you feel a stock is overvalued, that stock is a candidate, for your short selling. And by so doing, that particular act will help to contribute to efficiency in the market. Let's look at the risk of short selling. What are the disadvantages, the pitfalls, the drawbacks of engaging in short selling? Number one is unlimited potential for losses. If the stock price rises, because your hope is that the stock should or would fall, further. But really, in case the stock goes up, you will stand to loss. You sustain, losses. Number two is a margin call requiring additional capital to cover losses. When you start incurring losses, your broker will then give you what is called a margin call. You'll be asked to do or to provide additional capital to cover the losses you are incurring. And not only that, it's what is called short squeeze. Short squeeze this year is a situation where rapid price increase forces buying. You have to buy to cover your position. So you expect the stock to fall. If the stock does not fall and it keeps on climbing, you keep on buying to augment for your losses, to cover your position. That was called short squeeze. Number four is you are borrowing. It comes to usually when it comes to short selling, you may do it with borrowed funds. So the borrowing cost can equally reduce your overall profits, because these shares you are shorting, you borrow them from your broker, and so that particular borrowing cost, even when you make profits, will eat into your overall returns. The next item is common mistakes in short selling. Common mistakes in short selling. Number one is neglecting company fundamentals. You neglect company fundamentals. You discover that short sellers don't pay attention to how the company is doing financially. It is none of their business. They don't really care about the company overall fundamental characteristics. They neglect it. Number two is ignoring borrowing fee and transaction costs. When it comes to short selling, they don't really consider the kind of fee they're incurring and the transaction costs. They tend to neglect, they ignore those factors. Number three is they may end up over leveraging their position. That is, they will borrow kind of a huge amount of money. They are over leveraged. They borrow and borrow to be able to meet up, either in the case of a short squeeze when it happens, and that is a kind of end up making them to over leverage, over borrow to cover this phenomenon of called short squeezes. We equally have shorting popular stocks prone to short squeezes. If you short a popular stock, somebody mistakenly shorted Amazon and shorted Google, the individual almost went out of business, sustained losses. And someone said you don't short a cult stock. Some stocks are very popular, like Tesla. You go and short Tesla, or you go and short Amazon, or you short Google, or you short Microsoft. I'm afraid you may end up losing money. So even some experienced investors still, commit this mistake for reasons I can't really explain. All right, they go ahead and short these stocks where you understand the sustained losses because of the short squeeze that will come into play. And then not only that, when to use short selling. When do you really apply this principle of short selling? Number one is during market downturn or bear market. When the overall prices of stocks are going down in a bear market, that is the right time to apply the principle of short selling. But in a bull market, you don't try it because the stocks are moving high and they're moving very fast. They are going high very fast. Number two is to hedge your long position against sector-specific or market-wide decline. You hedge, you have your long position. So you want to like hedge or balance up or mitigate the risk in the entire portfolio so you can, apply, short selling. So once a particular fund manager said they look at the best companies in the world and they go long on them. They look at the worst companies in the world and they go short on them. By so doing, their portfolio is well balanced. Their risk, is kind of adequately mitigated. Not only that, when identifying stocks with unsustainable valuation or impending, negative news, it is thought that is overpriced. The valuation is just like is unsustainable. The stock has poor fundamentals, but the price is so high. These stocks will then later be corrected by the market, so you could short those stocks. And if you are expecting, an impending bad news, in a particular sector or as it relates to a particular stock, you could short that stocks. And so short selling is a powerful strategy, but requires thorough research, careful risk management, and a deep understanding of market dynamics to execute this process successfully. It's very interesting quite to read, but if you're not very careful, you discover that you will lose your shares as a result.